In this lecture, we introduce the sourcing of income for purposes of international taxation of electronic commerce. The topics we will cover in this lecture are as follows: the importance of income sourcing, the effect of income classification on the sourcing of income, the sourcing of income under U.S. domestic tax rules, the U.S. rules for sourcing software transactions, the U.S. rules for sourcing digital content transactions other than software transactions, other sourcing rules, and recognition of income under U.S. income tax treaties. Let's first look at the importance of sourcing income. Under international tax rules, the source of income can determine the taxability of that income in both the U.S. and foreign countries. For U.S. taxpayers, under U.S. tax law, a U.S. taxpayer is ordinarily taxed on worldwide income. Therefore, for the purpose of reporting income on a U.S. taxpayer's U.S. tax return, the source of income ordinarily does not matter. However, in calculating the net tax of a U.S. taxpayer, source can matter. For example, when calculating the foreign tax credit, the credit is limited to U.S. tax on foreign source income. And the credit against dividends from a 10% owned foreign corporation under Section 245A is limited to dividends paid out of a foreign corporation's foreign source income. So in both cases, we need to know foreign source income. For foreign taxpayers are ordinarily taxed in the U.S. only on U.S. source income. So we need to know U.S. source income. Let's look at the relationship of the income classification rules, which we've already studied, to the rules for sourcing income. The rules for determining the source of income under U.S. tax law depend entirely on the classification of income. Here's an example of the impact of classification. Webco is an online company that makes its software available for use online. As we discussed in the lecture on the classification of income, online software may often be classified as a service. As we will see later in this lecture, services are sourced where the services are performed. So if Webco has a customer in country X and provides access to online software to that customer, where such access is classified as a service, then the source of the income will be the United States, since that is where Webco performs all of the activities associated with delivering that service. Assume, however, for the sake of this example, that online software is delivered in such a way that it should be classified as a rental. Where this is the case, as we will see later, the income will be sourced where the property is used, that is, in country X. Let's now talk about the U.S. domestic tax laws for sourcing income. As discussed in the text, the United States has specific sourcing rules for different classes of income. The source of the income from the different classes of income, such as sales, rentals, licenses, and services, is determined using the sourcing rules specific to those classes of income. Let's begin by talking about the sourcing of sales of inventory. For sales of purchased inventory, where inventory is purchased and then resold by the vendor, sales are usually sourced where the product is delivered. Where inventory is manufactured or produced by the taxpayer and then sold, For years after 2017, sales are sourced to the country or countries of production. The object of sourcing is to attribute income to the country where the inventory is produced, that is, sourced to the location of production activities. Under a special rule, however, discussed later in this lecture, sales of inventory attributable to a U.S. fixed place of business can result in U.S. source income, even if the income would be foreign source under the previous rules. Here's an example of the sourcing of sales of purchased inventory. Webco is an online seller of books. The company does not produce its own books, but merely purchases books wholesale and then sells them retail. Webco operates entirely within the United States, except that it has a distribution center in France. Webco sells books to France and Germany. Under U.S. tax law, such sales will be sourced in France and Germany because that is where the products are delivered and where the ownership of the products changes hands. Here's an example of the sourcing of produced inventory. Bookco is an online seller of books that it produces. These books are sold only to attorneys. The books are produced by Bookco in the United States and sold in English-speaking countries throughout the world. Based on its books and records, production activity takes place only in the United States, so all sales are sourced in the United States. Let's carry on with the sourcing of rental and lease income. Rental and lease income is generally sourced at the location where the property is used. Here's an example of the sourcing of rental income. Webco provides subscriptions to professional software products. Customers download the software from the company's website and install it on their computers. Webco charges a quarterly fee for use of the software. If a customer stops paying the fee, then the software stops working. This arrangement will likely be a rental of software. This income will generally be sourced to the country where the customer uses the software. Let's discuss the sourcing of sales of intangibles. Sales of intangibles are ordinarily sourced to the seller's country of domicile. However, such sales may be sourced to another country if the intangibles were previously used in that country. Here's an example of the sale of an intangible. Webco, a U.S. company, is the owner of patents X and Y. Patent X is used in the operation of Webco's U.S. website, and patent Y is used in the operation of Webco's Country X website. Webco sells both patents to ForeignCo, a Country X company. Because Webco is domiciled in the U.S., the sale of patent X will result in U.S. source income. However, because patent Y was used in Country X, the source of its sale will be Country X. Let's turn to the sourcing of royalties from the license of intangibles. Royalties and other fees received from the licensing of intangibles are ordinarily sourced to the country where the intangibles are used. Here's an example of the sourcing of royalties from the licensing of intangibles. Webco is the owner of patent X. The technology subject to this patent is used in online transaction processing. Webco licenses the technology to ForeignCo, a Country X company. The royalties received from this license will be sourced to Country X. Now we turn to the sourcing of income from the performance of services. Revenue from the performance of services, including online services, is ordinarily sourced at the location of the property and personnel employed to provide and perform these services. Here's an example of the sourcing of services. Ford & Co. provides online access to GameX. For a monthly fee of $5, customers can log into Ford & Co.'s website and play GameX, which is a role-playing adventure game. Customers do not download the software to their computers, and thousands of people use the software at the same time. As discussed in the lecture on classification, revenue earned by Ford & Co. in this case is likely to be classified as services revenue. Services revenue is sourced at the location where the provider employs personnel and equipment to provide the services. If everything is in country X, then the revenue from services provided to U.S. customers will be sourced in country X. Let's talk about transactions involving know-how. A transaction involving know-how may be classified as a sale or license of an intangible. If classified as a sale or license of an intangible, then sourcing is based on the rules for intangibles discussed earlier. If there's a sale of a service involving know-how, then the sourcing rules for services apply. Let's talk briefly about software transactions. The sourcing of income from transactions involving software depends on the classification of software transactions. Once a transaction is classified as either a service, sale of inventory, rental, or sale or license of an intangible, or transaction involving know-how, the sourcing is based on the rules discussed in the previous slides. Finally, let's look at the rules for sourcing digital products other than software. Like software transactions, the sourcing of income from digital content transactions depends on the classification of these transactions. Once a transaction has been classified as either a service, product sale, rental, or sale or license of an intangible, or transaction involving know-how, the sourcing is based on the rules discussed in the previous slides. We have talked briefly about the general sourcing rules. Now let's talk about some special rules. Here are the special rules for sales of inventory from a U.S. fixed place of business. Under Section 865E2, a foreign person's sale of inventory to a customer outside of the United States is U.S. source income if it is attributable to a fixed place of business in the United States. As an exception, this rule does not apply where the sale is made for the use, disposition, or consumption outside of the United States and a foreign fixed place of business of the foreign person materially participates in the sale. A special version of this rule applies only for non-resident alien individuals who are classified as U.S. residents under Section 865G. A non-resident alien can be a U.S. resident under 865G by being domiciled in the United States, even though that person meets the requirements to be a non-resident alien. Where such a non-resident alien sells inventory from a fixed place of business to a foreign customer, that income is not classified as U.S. source income, but is classified as effectively connected income. Ordinarily, this rule for non-resident aliens will reach the same net effect as to the amount of income subject to U.S. tax as the rule under Section 865E2. Similar rules apply to sales of non-inventory personal property and services from a U.S. fixed place of business, and to other types of income. Now let's discuss income recognition under tax treaties. Tax treaties cover three types of transactions that are of concern to us. They cover other transactions as well, which are not necessarily important to e-commerce, and we will not be covering them. These three transactions are business profits, royalties, and sometimes technical services. We will be studying the recognition of income under tax treaties in Unit 10. So do not bother reading the text. The following is meant only as an introduction to the topic. In general, if there is a tax treaty, then the taxpayer can elect to apply the provisions of that treaty in determining taxable income instead of applying the provisions of a country's internal tax laws. That is, if the treaty applies, then its provisions override domestic law. For example, the provisions of a treaty can override the U.S. tax code. It is important to understand that a taxpayer does not have to apply the treaty if that treaty is detrimental to the taxpayer. However, treaties are ordinarily beneficial in reducing the amount of taxes paid in a particular country. Let's first focus on business profits, which are of primary concern in electronic commerce. Under a treaty, business profits of any kind, including services, leases, inventory sales, are taxed in a country only if they are attributable to a permanent establishment in that country. This means that if there is no permanent establishment in a country, then the taxpayer is not taxed in that country on business profits. And if there is a permanent establishment in that country, then only those business profits attributable to the permanent establishment are taxed. The rules for finding a permanent establishment and the rules for attribution of income are discussed in the text. Royalties are also of great concern in electronic commerce. As discussed in the text, royalties are generally taxed in the source country, that is, the country where the property generating the royalties is used, but such royalties are often exempt from tax in that country by tax treaty. Finally, technical services are often taxed in a source country, as discussed in the text, but few tax treaties currently address such services.